What's up, everybody? Michael Silva here. In today's video, I'm going to tell you how to outperform the S&P 500 in 2022. Yes, if you're new here, welcome to the show. This is the Stock Market Brief Show. We use technical analysis and intermarket analysis to get a good idea as to where the market might be headed next. We're going to be getting into yearly charts, monthly charts, weekly charts, etc. But before we do, I want to get into an approach that not many people talk about, except for, well, the best traders in the world, and that's all about position sizing when it comes to trading. And it's very important, especially to get a good start into the new year. You may have seen this stuff before, but you may have not, and you'll probably be pretty surprised at this math. So let's go ahead and get into today's episode. Welcome back, everybody. So as soon as I just Google 2022 stock market, you all of a sudden see, just a bunch of different things, predictions, stocks to watch, etc., etc., etc. Look, we need to really cut back all the noise coming into this year and get very focused. If your goal is to make money or grow your account, you really need to focus not on what might be the hot stock this time or that time, etc. We need to really focus in on how to start positioning ourselves to really outperform the S&P 500. If you've watched this video, this is where I kind of go into how you can make consistent profits. I talk about risk to reward. And it's a very important concept to understand while you're approaching the market. In that thumbnail that I showed you, I talk about the 1 to 3 risk to reward ratio. And that's basically where you risk 1 unit to potentially earn 3. But in today's example, I'm going to break it down to a 1 to 2 risk to reward ratio. And this is really important. So I want to just start off. This is right here. I learned this from stock market wizard Mark Minervini. And this is just an Excel document, but I want to show you just how important it is to build on success, starting small and then kind of leveling up. And what you'll see here is I'm just putting a $10,000 portfolio size here, and my average loss is going to be around 4%, but just forget about that right there. I'm looking at trying to get an 8% gain on my positions. That's it, okay? And I'll go into why that's important here soon. But what I want to show you here is, if I'm trading a $10,000 account and I'm saying a full position, so, if you look at the way that you trade, kind of building up into a position. So say your full position, okay, a full position is going to be 25% of your portfolio, okay? So that means a full position is going to equal $2,500, all right, in this example. So the largest position on a single stock that you'll take is 25% of your portfolio. Now, this is where it gets really interesting. Instead of just hopping into full-size positions, which most people do, right? They go bananas into positions, and then, if they lose, it puts a lot of damage. It's harder to recover. If you start focusing in on maybe a quarter position, half position, and then full-size positions, and then slowly build up, look at what takes place here. So, for example, if we're trading a $10,000 portfolio, my full size is typically a 25% position. Let's start off with a quarter position. So what does that mean? Well, that means I'm only risking $625. That's at risk. That doesn't mean that I'm risking that in dollar terms, unless the trade goes to zero, which is, it's always possible, but it's highly unlikely given certain parameters. And I'm not going to get specifically into the parameters of, the types of trades that I take, but let's just call it a quarter position, 6.25%, and you win this position. Look at this, okay? So with the 2 to 1 risk to reward ratio, you are gaining 50, you're risking $25. You might be thinking, dude, that's nothing. Why would you that's not enough. Just bear with me here, okay? So you take a quarter position. Hey, okay, cool, you won it. Now you're going to go into a half size position. Okay, a half size position is going to be 12.5%. Why 12.5? Well, that's half of 25%. Okay? And say you win that one. Okay, so remember, we're starting off small and we're building on our success. And when you're trading good, it allows you to scale up your positions. So in this one, you win $100, right? Okay, and you were only risking 50. Now your profit and loss is right at around 150 in this example. So now you're scaling up. Okay, I'm ready to take on a full position. This is where it gets very interesting. Say you win this full position, right? You get that 8% gain, right? You're risking 25% of your portfolio. That was actually just the 10,000 size. That doesn't actually take into account these recent gains. Okay, and there's so many different ways you can do this. But say you win that one. Okay, so now you have 3 winning trades in a row. that you basically just got 8%. How hard is it to find a stock that goes up 8%? It's not hard, right? We'll get into that. We'll get into what I mean there soon. Okay, so say if you do this, you start off small and you build up to a full position, you won, bam. Your profit and loss is 350. Now, most people don't realize this, but you know what you just did here? You just now made it possible to take 3 more full-size positions. And if you lose not 1, not 2, but 3 full-size positions in a row, you're still up $50. So this right here, building on your success as starting small, allows you and funds 3 full-size positions. And that right there is how you start small and build upon your success. Now, if you lose 3 full-size positions in a row, do you really think like you started really good and now all of a sudden you're doing not so good? So what you would do in that case is probably start back over and start small until you start performing again. And once you get a winning streak, you might go quarter, half full, but then you might go full. Right? And then you might start really building upon your successes. So what you need to focus on in 2022 if you want to be successful is how you're positioning yourself. You know, the size, the type of positions that you're taking, and then building, kind of snowballing into larger positions and only risking, by the way, we're only risking up to 25% of the portfolio. So we're still in heavy cash there. Now, why did I use an 8%, basically, a 4%, to 8% win, right? So that's a risking 1 to potentially earn 2. It's a 1 to 2 risk to reward ratio, all right? The reason why I did that is because of this right here. So look at this, 5%, 10%, 20%, 30%, 40%, and so forth, all the way down to 200%, okay? And then let's just say this axis right here is the amount of stocks that we see that go up this amount of gains. This chart right here would look like this. And it would fall off a cliff, right? You can find a lot more stocks that go up 5 to 10%, right? A lot more stocks way more frequently on a day-to-day basis, way more frequently than trying to find these high flyers up here. But yet everyone wants to romanticize and look for just high-flying stocks. They want to find the 90, 100, 200% gainers, but it's much more rare and it typically takes much more time. All right. Now, even you can find 20 and 30% stocks, but even from that point, it still gets a lot lower on the time scale. It takes more time and it's harder to find, but it's significantly easier to find stocks that move around this. So if you put your focus into something like this, say between these two, right? The example that I got from Mark Minervini was he was using 8%. So I want to show you this. This is pretty cool. All right. So if our balance is $10,000, and I'm just going to show you how things compound. All right. And I want to just give you this example. So only 25% of your balance, we're going to be doing full size position here. And that means we're going to be starting off we're going to be putting at risk $2,500 in capital. All right. And we're only focusing on getting 8% gains. Some will be less, some will be more. But for this example, like say if you took, I don't know, let's say you took 100 trades. All right. And in this example specifically, 92 of those trades ended up making you just break even. All right, so you had some winners, you had some losers, but you were able to compound a total of 8 full-size positions. So if you had a balance of $10,000 and you started off with just only playing 25% of your capital, that means you're only at risk. You're mostly in cash, right? You're mostly in cash for the most part. But watch just how powerful this is. If you only took that into consideration and you had only 8 trades that compounded that 25%, that's a 17% gain. So you do not need to be trading super frequently. You need to find these high quality setups and you have to be managing your risk very closely, and you need to be able to find just these small winners that take place every single day. So if you did this, right, yeah, your balance would go from 10,200 to 11,714. That's a 17% gain. That's pretty darn good and typically easy to find. Now, say if we just added another 8 more trades. The S&P 500 was up 26% this year, right? So this is crazy, right? If we got to just trade 12, say if we're able to do this once a month, that would put you at a 26% gain on your capital. Right? If we kept going down that list and just kept on being able to do this time and time again, and we became very good at not only finding good setups, but very, very good at managing risk. Look at that. It's a 37% gain just in 16 trades, being able to compound a full-size position over and over again. That's powerful stuff, especially if you do the math for yourself. And we're not getting crazy with these 8%. Like, it's not hard to find an 8% gainer. You see that on a daily basis. Now, I want to give you an example. This is one of the stocks that I shared just on the Discord. I share stocks all the time on the Discord. If you're not part of it, there's a link in the description. It's $9 a month, and I just give out trade ideas. All right, trade ideas they're powerful things. There's a good, powerful community in there, but it's only powerful if you really understand the concept of managing risk, right? A lot of people will hop in, and they'll just be like, I'm just going to go all in on this one position. I hear he's going in. That's not how it works. You need to start small with a quarter-size position, do good, build on that success, go to a half-size position, build on that success, go to a full-size position. And now you just funded, guess what? 3 full-size positions. And if you lose them, guess what? You're back to break even. Big deal. All right? So this is one that I posted, I think, December 22nd. And I said basically, yeah, if it breaks out, you can take an entry and then have a stop loss right down there. That's about a 6%. Actually, here we go. Let me go down to this right here. I'll show you. Bam, we started breaking out, okay? So say if you entered into it and it came down and then stopped you out, okay? You're down 6%. If you actually wanted to have a stop that low, right? And 6%, that's actually, you don't want to go too much more than that. So if you took a quarter position on this, then you only lose 6%. All right, if you wanted to only have 4%, you could have been hiding behind this candle or trailing the 50-day or 20-day. There's multiple ways to set it up. All right, but see, it broke out and now it came up 5%. So we're up about 5% on this position. And we came into this area of resistance. Now what I want to show you is you got to learn how to free roll your trades. How can you make it so you have no risk on the table, right? The only risk is the capital at risk, but you're managing it with a stop. So the top position here, the trade was set up with a potential 6% loss, but a 14% gain. So, it's about a 1-to-2 ratio right there, right? So it's just about a 1-to-2 ratio, a little bit better. All right, so what can you do here at this point? Well, one simple technique is you can remove 50% of your position right here, and you're basically now capturing in some gains, and you're free rolling the position. You can even take this stop up while you do that, and now you're really free rolling the position. So now if it keeps on going up and it hits this target, you can take the whole percent off, or you can just continue to let it run and see if it keeps going or if it comes back and stops you out. Another way to do it is just instead of taking profits here, you could just move your stop here. But if this turns back around and hits your stop, then it's once again a break-even trade, but you didn't lock in any profits. So you got to constantly be thinking how you can mitigate your risk and how you can compound your success. All right, that's what you need to think in 2022 to really, really outperform this market. So I hope that helps. It's just a little quick tip and just some math that I wanted to share with you. Now it's time to get into the stock market brief show, everybody. All right, we're going to go through this fast because that was a big portion of it. We've got a lot of charts to kind of go over. We're looking at the performance here on Friday. All right, now if you watched the previous video, I haven't been putting too many out, and the reason why is because, well, we hit our expected move and the market didn't go anywhere because of low volume coming into the holiday season. One thing that I did notice is just the defensive names have been kind of creeping up higher. We had a down day in the markets, as you can see right here. Let's continue on. We are now looking at the week performance from last week, and you can see here, real estate, utilities, consumer staples, in the top 4. Kind of defensive posturing there coming into the new year. If you take a little bit more of a scaled approach, we're looking at 4 weeks. And what we're looking at here is a relative rotation graph. Where's strength coming in? Where's it rotating? You can see technology is still in the leading sector on this 4-week basis. But what I want to point out is XLP and XLU and XLV, some defensive names that's going from bottom left to top right. They are moving into the improving quadrant, and they look like they're trying to head into leading. So it does seem to me that there's a little bit of defensive posturing taking place coming into the new year. All right, so if you're looking to go super hardcore right out of the gates, this might tell you to, hey, just take a little bit of a breather before you do that. All right, let's see what the market brings us and see what sets up. Let's look at the S&P 500 year-to-date performance. This is a yearly chart. We are tagging an upper trend line. I'm not going to put too much focus on this, but we're up 26.89% for the year. The quarter On the quarterly chart, we are above the upper Bollinger Band. So yeah, I mean, pretty overextended, right? The overextension can stay overextended for a long time, up 10.65% on the quarter. If we get some sort of big drawdown, always pay attention to that 5 EMA at 4227. It'll probably go up here momentarily. It'll probably drag up coming into the next week. So we'll see where that is. And that can always be something to keep an eye on just in case if price comes back, because it does act as a level of support. If we take a look at the weekly performance, we put in a little bit of a shooting star type candle, but we did break out of this zone over here, and we are disconnected from that EMA. The 5 EMA right there, but overall still in bullish context. Higher highs, higher lows, above the key moving averages. Let's continue. Then we got the daily time frame. All right, the daily time frame, what I put out here is these blue lines. The blue lines represent what the market is pricing in. The options market is pricing in for next month. So typically what this means is 70% of the time or just below that, that means options for next week are going to expire within this range. And it's a good idea to keep an eye on this range because it allows you to see volatility. We kept on it last week and we said what? We said, well, the low end is here, and we basically came right back up and then tagged the upper range of it. And we were ready and we were prepared. And then the following week, or if it was the previous week, it was such a volatile week. I'm losing track. It could have been, actually, I think it was actually, this was the expected move from up here to down here. And it basically tagged it to the low. Oh, no. Yeah. Last week, sorry, my apologies. Basically, the upper edge of the expected move was right here, and I think the other edge was down here. I can't remember completely. But basically what happened was we tagged on Monday the upper edge of the expected move, and then it just dragged sideways, and then we sold off slightly there. Now what the options market is pricing in is right up here to right down here. Now if we take a look at the price action, you can see it's been a very aggressive move to the upside. So the market's trying to digest. If it comes down here, that's going to be still above the 20 and the 50-day moving average and above this breakout area. I think it's more than possible to see it come down here and retest. And if we start getting more extended, I mean, it could present itself an opportunity actually to start going long. So we'll keep an eye on that coming into next week. But as it stands right now, that would be a key area of support to watch, right around just above 4,700 on the SPX. Okay, let's continue. Let's look at the Nasdaq 100 on the yearly time frame, up 26.63%. That thing is just flying sky high. If we take a look at the quarterly chart, it's outside of that upper Bollinger Band, and the weekly 5 EMA is at 14,257. So always look for a potential reconnect of that, because obviously the quarter is going to be starting here soon, and we're going to be disconnected from that quarterly EMA. If we take a look at the weekly time frame, that is not the greatest looking candle, right? Shooting star candle has a long upper wick. We closed at the low of the week. We're up basically, very slightly, but pretty much flat on the week, but we were still above some key moving averages as price is really just continuing to track sideways. I'll go over some indicators in the indicator section. The expected move coming into next week at the beginning of the year, also it's more compressed than the previous week. So when you looked at the S&P 500, what you'll notice is it's actually not that much volatility coming into the new year. And which that to me is kind of interesting, because we're seeing defensive posturing, all right, and then we're seeing volatility. The VIX, it's been kind of crushed down, and then the expected move in the options market is not too dramatic. So it might be a slow start to the year, and we got to just kind of sit that out, be patient, look at some key levels, and see if anything sets up. All right, so what we're pricing in here is a potential move right down to the 50 and 20 moving averages, which is just above 16,000. And then the upper edge is right there just at the previous area of resistance. So it looks like potential trading range for next week. If we look at the Dow Jones, up 18.73% for the year, almost closing at the yearly high there too as well. If we continue on the quarterly time frame, also outside of the upper Bollinger Band there, and we're going to be disconnected from that EMA at 33,463. Let's continue to the weekly time frame. The weekly time frame doesn't look all too bad, but let's just be honest, it's in this trading range. All right, we went up, we tagged it, we came down, we found support, we came back up, and we tagged it. So to see it come down a little bit, I wouldn't be too scared about that. We are still above the 30-week the 40-week, the 20-week, and then obviously the 5 EMA at 35,841 right there too as well. So like I said, it looks like we might get a little bit of a pause coming into the new year. You know, who knows? The Santa rally is still technically on, but we'll see here as we've already got a pretty aggressive move coming into the end of 2021. Let's take a look at the Russell 2000, up 14.54% for the year. I don't even know how it's up 14.54% for the year because it's been going sideways for an entire year. Quarterly chart. We got outside of that upper Bollinger Band, but then we created a long upper wick and we came back down, creating somewhat of a shooting star candle. But overall, we are just going sideways still at this time, and we're above the quarterly 5 EMA. And look at that. It acted perfectly as a level of support. So if we start cracking down through that, it's not the greatest look, right? Nope, it's not. All right, let's continue on. Weekly time frame, not much to report here. We broke out over this way, right? Little bull trap, and we're still continuing to press sideways as we're below the 30-week, the 200-week, or the 30-week, the 40-week, which is the 200-day moving average, and we're slightly above the weekly 5 EMA. All right, so just sideways action. And you know what? If the market wants to keep pressing up the S&P 500, we're going to need small caps to perform too as well. All right, if we look at the daily time frame, where is the market pricing in the move? Also, not that big of a range of volatility, and it's still within the middle of this trading range. We can get up to 227.50 on the upper edge, 217.50 on the lower edge right there. And we are putting in some shooting star type candles. Look at this big aggressive candles moving up. Okay, big body candles to narrow range candles tells us momentum is slowing, and then the upper wicks can be considered topping tails. It says to us that, hey, we might get some price action to come back down. So coming back down here, you know, would actually technically make sense. So we'll see if that's the case coming into the new year. Now, what to watch for if we start breaking down through these levels and we see increased volume. So basically, this came up on low volume, but if it comes down on high volume, you know, that's a little bit of a red flag, and that goes with all of those indices. Let's hop into some indicators. This is the sell signal and also the buy signal that I like to use. CPC, we've been keeping an eye on it. It's when it crosses below 0.8 and then crosses back above. When it crosses back above, that is the sell signal. And you can see this was the buy signal as it crossed from above to below, and we were prepared for that. So I'm going to continue to keep an eye on this. If it does cross below, I'll let everyone know. And when it crosses above, or when it's about to, I will let everyone know too as well. But we're still riding fine right there. Here's the Nisey McClellan oscillator. And as you can see, the New York Stock Exchange, the NIA, putting in some topping tails right there. You can see big range candles. Momentum with the narrow bodies right there is slowing. We have a slight negative divergence there too as well on the oscillator. To see this come down, would you be surprised? I wouldn't be. If we take a look at SPIP over GOVT, this is tips over treasury bonds. I like to apply the 10-day rate of change, and for some reason, it's been working where it gets above 1.3 to 1.5. You can see these red lines. It's been a little bit of a leading indicator to see a little bit of volatility. For the last 1, 2, 3, 4, 5 times, it actually worked. Does that mean it's going to work every single time and this is the holy grail? No, it doesn't, but we just recently tagged there, and volatility has been kind of falling off a ship. So if we see a little pop in volatility, you know, don't be too surprised, as a lot of things are already overextended at this current point in time. If we take a look at the VIX, you can see the VIX, this line right here, this blue horizontal line, has been acting as an area of resistance and clearly support, resistance again, and it's just kind of getting crushed lower and lower. We had a small positive divergence there. We popped up. Now we could be potentially flagging at this point where we get another pop. If that's the case, that'd look kind of like a inverse head and shoulders, and then we pop up even higher to around these two gaps to potentially even those gaps to get filled. That would be the risk to the downside in the S&P 500. Now, another thing to call out is the XLU over SPY. This is Michael Gayad's beta rotation strategy. It lets us know really just a little bit of a warning sign. And what I like to do is when it crosses above 0.0, the 4-week rate of change, it lets us know that, hey, utilities is outperforming the SPY at a higher rate of change. And when that's the case, as we're seeing right now, utilities is outperforming the S&P 500, right? And what we're seeing also is consumer staples and more defensive posturing taking place. So when this crosses back below, that'd be more of a risk-on environment. But as it stands right now, we're still above 0, so it still remains a risk-off. Does that mean get out of all your trades? No, don't trade. That's not what it means. What it means is, hey, if you're driving down the road and it's sunny out, you can go a little bit faster, right? There's less obstructions in the way. But if it's pouring, storming, traffic, it basically means risk off, take your foot off the gas a little bit here. That's what that means. If we take a look at some health dashboards, New York Stock Exchange, we already talked about the topping tails potentially right there. It's been underperforming the S&P 500 really since it got below that 50 period moving average. The NIMO, it's actually in the green, so we'll continue to watch this to see if it does cross down through zero. That's more of a sell signal. And then the NIAD did get back above the 50 period moving average, so we'll see if that actually builds upon itself. So that's actually not a bad development, and being above zero, it's not a bad development. It's the price action itself that doesn't look all too hot right now with those topping tails. So maybe we're just going to need a little bit more time, a little bit more consolidation, or just a big powerhouse candle out of that little range. Take a look at the Comp Q, Nasdaq Composite. All right, the Nasdaq Composite. We are currently flagging at this particular time. We're seeing a little bit of sell side right there. Not much to report here, right? The advanced decline line, it's below the 50 period moving average. It's been sinking lower. Not the greatest look. And the Comp Q over S&P 500, the relative strength line is below that 50-day moving average there too as well. If you look at new highs and new lows, nothing really to report here. New highs have been sinking off a ship. New lows have been seeing these pops, which is not the greatest, as we're not far from the all-time high. So there's just been some overall weird stuff. Like I said, we need more time. Let's take a look at a couple of the bullish percent index charts. I like to use these as overextended to the upside or downside to kind of let us know when to take our foot off the gas. It still has room to potentially go up, so we're looking for an overextended reading above 70 there to really kind of take our foot off the gas. That's for the S&P 500. So basically that just says, hey, we still got potentially more room to run here. If we take a look at the BPNDX, Nasdaq 100, it's not too far from getting overextended, so we'll be keeping an eye on that. Still says it has room to go. And we got the BPCOMPQ. The Nasdaq Composite still looks like it has some room to go to get to that overextended area. One other thing I want to pay attention to here is the relative strength of the Fangman stocks. The big dogs, right? Facebook, Apple, Nvidia, Google, Microsoft, Amazon, and Netflix. They are underperforming the S&P 500, and they're below the 50 EMAs. The Netflix it's been going down. Amazon is below it and it's heading down. Microsoft has been a powerhouse. It's going sideways, and it just recently crossed under the EMA 50. Google has been going sideways and crossed down through that too as well and heading down. Nvidia, just about to cross down beneath it, has been a very strong performer. Apple is the one that has been performing the strongest from a relative standpoint. And you can see here it's been going up, and now it's been just kind of consolidating right here, the relative strength line. And, it makes sense. There's a lot of liquidity in Apple, and we saw a big pop there towards the end of the year. Facebook has been underperforming too as well. It's trying to get it back above that EMA 50, but you can see it's kind of just flattened out right there. So these are big dogs, right? The mega caps. In order for the S&P 500 to see a good year, well, it's going to need the help of these stocks. And if it doesn't have the help of these stocks, well, it's going to be a pretty stagnant year for the S&P 500. Are we going to get another 26%, gain on the S&P 500? Well, we're not going to get there if we don't have the big dogs helping us out. All right, it's as simple as that. Let's take a look at commodities. Gold actually don't look too bad, right? We got to get above this like 1875, but you can see here some volatility, right? It came down and now it's kind of tightening up right here. So it could be potentially just kind of cupping, and then if we start breaking above this kind of area right in here, 1900, 1925, that can really set us up for a move higher. So we're not there yet, but it's not looking bad from a weekly basis. Silver, on the other hand, below the 30-week moving average. We're right there at the 20-week moving average, getting back above the 5 EMA on the weekly time frame. Really, this has not gone anywhere. It's been going sideways like this. Doesn't look as good as the gold chart, but hey, if we start getting it back, above the 30-week and back above 25, that can set us right up to get up to 28 to 30 fairly quickly, right? It could get us there, but we'd still be within a trading range. If we take a look at copper also is looking pretty bullish at the particular point in time. We saw this volatility come down, and now it's tightening up a little bit here. So as long as we stay above 4.0, that'd be pretty solid as it's continuing to kind of just track sideways in this base. If we start getting above 4.8, that can set us up to obviously, boom, boom, head higher there. Now, let's hop into WTIC. WTIC has been seeing some more volatility. This could be a broadening wedge pattern, an ascending broadening wedge pattern, where, it came up and it could come back down and crack down and head lower. We'll see if that's the case. But as it stands right now, we had a sharp sell-off, we had a sharp sell-off, we had a sharp sell-off, contraction, expansion, and now we're kind of bouncing at this point. So maybe we kind of, doodle up and head higher. But if we start taking out this low right here, be careful. Be very careful, right? Because not only would it be really that low that it'd be taken out, it was previously resistance, and then it's support and support. So if support is taken out, it could be once again into resistance, okay? And that could be pretty bad for WTIC. Let's take a look at some crypto stuff. Here's the Sailor to Shift indicator. We are below zero, so I think Sunday is when the Bitcoin candle officially closes. So, it's still moving. But right now, it doesn't look like we're going to be obviously closing above the zero line. So we did not get the buy signal. Okay, so the buy signal was up there earlier in the week. And we basically said, it was Monday, I believe it was. And we said, hey, yeah, if you want to front run the signal, you can do that. But in theory, we haven't had the official signal. All right. So if you front run it, it's sold off a little bit. Now it's bouncing. Overall, from the price action, it's just still going sideways. All right, so not much development. It still could be potentially that bear flag, so be careful. If we start getting back above it, and then we start getting it back above the previous week, so basically 52,500, that to me would look pretty good. And you just got to be ready to at least to take a position, or I'd say just be ready to take a position if that is the case, and then just still manage your risk. Okay, it's not the holy grail. All right, everyone thinks that sometimes, like there's a holy grail, but there's not. All right. The reason why I use a 4-week rate of change on this, for those that don't know, right? If you've never seen this before and you're like, what is this thing? Well, basically when it crosses below this zero line, that's that sell signal. There's some stipulations. I put together a video for it, but it's to protect us from large moves to the downside. Now, if you started this in 2021, if you bought crypto in 2021, the very first of 2021, right? And you're like, I'm going to buy, and then I'm going to follow this. Okay, you would have caught this move. You would have saved yourself from that move. You would have caught this move. You would have saved yourself from that move, and then you would have caught that move, and then saved yourself from that move. So yeah, you would be up significantly more than just the regular price of Bitcoin on the year. That's the strategy that I use at this current time. Let's continue on just to the daily time frame. The daily time frame, we broke out of that wedge, looked pretty good. People got very excited, but we had to call out a few things. What did we say? We said, I don't like how it was breaking out on low volume, and then it started contracting. All right, so contraction leads to expansion. That's non-directional bias. It can go plus or minus. This case, it did go down, and it's underperforming the S&P 500, which I do not like to see at this particular point in time, and it came down on heavier volume. All right, so we're still kind of just tracking sideways at this particular point in time. Another chart that I don't like of Bitcoin is the quarterly time frame. Don't put too much weight on this. All right, don't put too much weight on this. But that candle, that's disgusting. That means that's just a gross candle. Like, it came all the way up, and then we came all the way back down there, a huge topping tail. Now, that means to me, that doesn't mean anything, but if we start cracking below that low, or have a quarterly close below that low, which is, 42,500, it can drop, and it can drop fast. It can go boom and come right down to 30,000. Easy. All right, and 30,000 seems to be a key level. It was where we basically had resistance there. Started off as support, we came all the way back down again, and we came back down again. So all that price data right in here, clearly, it sometimes can act like a magnet. So if we get below that, boom, it could be quick. All right. So be very mindful of that key level. So if for some reason, if we just start seeing just a massive sell-off, and we're coming into this 27,500 to 30,000 range, and you want to be able to take a position into it, just be aware, like, oh wait, no, I remember the quarterly time frame. There's actually a lot of buyers there, and there's a lot of price data there, and it makes sense from a risk to reward standpoint to enter in. I'm not calling for it to happen, but just pay attention to it. Ethereum came back down to test this trend line again, and we're seeing a bounce a little bit from there. Once again, I do not like how we have been underperforming the S&P 500. So until this starts getting back above that 50 EMA, and we start getting the buy signal again, I'm going to be a little bit more bullish. And then also, it's not just Ethereum and Bitcoin that I'll be paying attention to. I want to get into some crypto equities, BITF, HIVE, HUT, MARA, all those tickers. When we start see these buy signals and start to see these crypto things turn up, if it does take place, well, I think that generate more alpha, to generate more A, I don't want to spell out the whole word, to generate more alpha, if you want to beat Bitcoin, I think some of those crypto equities they'll run significantly higher, obviously, than the price of Bitcoin. Probably, maybe they might run the same amount, but in the period of time that it takes Bitcoin to run 100%, it can take, like something like HUT or MARA or something like that. It can take a significant shorter period of time to reach something like that, one of those levels. Take a look at the dollar. All right, the dollar on the monthly time frame hit somewhat of a shooting star candle. The reason why I'm showing this is because we called this out a long time ago. Every time they had that bullish crossover on the PPO, we started heading higher. We called it out right here. We started seeing it move up, and we basically said, hey, watch for a potential tag of this trend line and the upper Bollinger Band to get some weakness. We haven't quite got there yet, but we're seeing some topping tails take place right there as we're above the monthly 5 EMA. Let's continue moving on. The higher this goes, it could put pressure on equities and obviously commodities. If we take a look at the weekly time frame, it tagged our target, and we've been talking about that target since way back here. Every candle represents 1 week of data, right? The monthly candle, every candle represents 1 month. And you can see here, not the greatest looking week as we tagged into our target, and now we're starting to see it sell off a little bit. Could be period of consolidation at this particular point in time, but we don't know yet. I looked at this as a potential pennant pattern, and then we had a weekday on the last trading day. And the reason why I show these purple lines is because, when the dollar flies up, it puts pressure on the S&P 500. Dollar flew up, S&P 500 headed a bit lower. Then when the dollar was up here and started heading down, S&P 500 went up. All right, now what I want to call out is we're still within this trading range. If we start breaking down from 95 and we start heading lower aggressively, maybe S&P 500 shakes this little downside move off, or we come down, but then maybe that acts as support. If the dollar wants to start heading down, it could very well help equities. And we've seen that happen time and time again. It definitely helped commodities, so keep a close eye on like gold miners potentially. But if we start seeing the dollar rapidly rise back up, that could potentially create some more volatility here in the S&P 500 as well as commodities. Let's take a look at bonds and yields. I like to look for potential inversions here. So I look at the 10 and 2, the 35, and you can see here the curve, it's just kind of going sideways. Same here, it's kind of curling over to sideways. Look, it was pretty expanded here, and you can see the yields, they're contracting tighter and tighter. When you get to those inversions, that is a leading indicator of a potential recession. And as it stands right now, we're seeing the 2-year just take off, all right? And then you can just see these yields are getting closer and closer. The 7 and the 10 got very, very close, and they're still very close. Perhaps they might actually get an inversion here coming 2022. We'll see what takes place. So many eyes are going to be on the Fed policy. What are they going to be doing? Are they going to actually tighten? Are they going to follow through with what they said? A lot of people are saying, nope, no way in heck they're going to be able to do it. But if they do it, those people that say that, they're going to have a rough period of time if they're going to stick to their convictions and not change to what is actually taking place with the Fed. And by the way, I don't see how it's possible for them to actually pump through 3 rate hikes and also aggressively taper, and then the markets just to kind of shrug it off. I find that to be a little bit difficult to believe, but I've also seen other things that are difficult to believe, and they took place. So let's take a look at the TNX 10-year yield. Still, that head and shoulders is forming. So if we start breaking above that, bam, and we start seeing that move at a rapid rate of change, that can put pressure on, obviously, big tech. And if we see big tech get hit, that obviously does not play out too well for the S&P 500 and the Nasdaq 100. If you take a look at TLT has just been in a trading range. Not much to report there. We had that breakout. Everyone got super excited, all the bond people, and then it ended up being just a bull trap, and we started coming back down. Now we're forming more of a wedge pattern at this particular point in time. So which still leaves the possibility to shoot up, and that could be a safety trade. We might see the S&P 500 come down if this shoots up. All right, so something to keep an eye on there. All right, this was a long video. Just to wrap it up, okay? You want to outperform the market in 2022? Well, I'll tell you what you need to do. You need to focus. You need to focus on position sizing, starting small and snowballing into larger positions. Like I said, quarter position, half position, full position, that can fund not 1, not 2, but 3 full-size position trades. So basically what this is saying is you want to build on your success And when you start to fail, it doesn't mean you're a failure. It basically just means, hey, start lowering down or start taking a break because the market is not in the right conditions for you to be trading. And then when it turns back in your favor, get back on that horse and start continuing to build. You can do it. I know you can. I'm going to be there in the Discord all year. If you're not there in the Discord, come on in. We've got a great group of traders and people in the community. See you later. And